Eric, Keiko, Melany, and Patrick. Hi all, nice to meet you.
You too.
Hello, it's very nice to meet with you.
And Patrick, you have a camera there? Patrick's going to be our mystery panelist. Keiko, what's the process for starting?
So I think we can start. So we are supposed to start at 11:30, so we are right on time. So before I hand over to you, I'll just do a quick intro. So Bruce here is a co-director at Tamer Center, and I had the privilege of doing climate finance course with Bruce, so really know him well, and like he's really passionate about this topic. So really looking forward to an amazing panel discussion. Over to you, Bruce.
Thank you very, very much. Nice to meet everybody here on this panel, this event. Just want to make sure we have everybody on here live. Just wait 1 minute for everybody to come up on the screen. Okay. One panelist is going to rejoin. I have a little tech issue. That's Patrick Bydume. So why don't we just get started, since we don't have a lot of time together, 40 minutes, and we'll go from there. Oh, there's Patrick. Perfect timing. Welcome, Patrick. So let me welcome all the panelists to the panel. We have Eric Eyberg from Wood Mackenzie, Keiko Hondo from former CEO of MIGA, Patrick Bydume, a director at BlackRock, and Melany Vargas, director at Wood Mackenzie, but in a different area from Eric. So we're in a range of expertise from Wood Mackenzie. Really appreciate everyone joining us here this morning. Nice to have you. We have 40 minutes together. And what we're going to do is, for those in the audience, I'm going to ask each panelist a very specific question that speaks to their area of expertise and knowledge. And then I've got some open questions for the panelists that I'm going to ask all of them. And if you want to add any panelists in the Q&A box, I'll try to monitor that at the same time as we go through this. So Eric, if we could start with you, because as you hear the question, it's a real-time question, I guess, unfortunately. And the question is around the fact that industry analysts are predicting a transition from fossil fuels to renewables. Everybody's pretty much on board with that. The question for you is, does the war in Ukraine and the energy crisis in Europe impact that transition? And if so, does it speed up the transition? Does it slow the transition down? What are your thoughts on that, Eric?
Great. I think that's one of the $billion, or shall I put it, $1 trillion questions of the day, Bruce.
Yeah.
At WoodMac, we think about the future of the energy industry by applying the energy trilemma framework. And there are a lot of different energy trilemma approaches, but at WoodMac, that includes managing the competing demands of affordability and security and sustainability. And I'll just briefly define those. They're pretty straightforward, but energy affordability is a country's ability to provide universal access to affordable energy. Energy security, again, relatively straightforward. It's the nation's ability to meet current and future energy demands reliably and with a resilient system and to withstand shocks. And then environmental sustainability of energy systems really represents the transition of a country's energy system towards mitigating and avoiding potential environmental harm and climate change impact. And so when we think about the energy trilemma, we've seen, as you mentioned, continued gradual coalescing around a global response to climate change. That's been evidenced by COP26 in trying to limit warming to 1.5 to 2 C trajectory. The energy industry and countries and governments have really balanced affordability, security, and sustainability goals. And at WoodMac, we've certainly seen that from our clients, as well as pretty much every project today has an energy transition angle. But the Ukraine crisis has rapidly changed the focus of the priorities of the energy trilemma towards energy security, especially in Europe. Not a surprise. So Europe is moving quickly to reduce its dependence on Russian supply shock. And so just some numbers, Europe depends upon Russia for 38% of its natural gas, 18% of its oil needs, 15% more or less of its smaller coal import requirements. Oil, of course, is a more fungible market, but we'll certainly see challenges. Russia's the #2 producer in the world. We're looking at both supply side, demand side impacts. High prices, those could have inflationary impacts. They could have recessionary impacts if they last too long. The initial reactions on the oil side have been dialogue from head of states and OPEC members. We've also seen, of course, the US and Venezuela discussion that started, but it's really the natural gas supply shock that's the real game changer. Global gas and LNG markets were already very constrained heading into the crisis. And the European Commission is laser focused on energy security now. They've stated they want to reduce Russian gas imports by 2/3 by the end of the year, which is obviously an incredible goal. We'll talk a little bit about just how hard that is to do in a second. But just in a matter of weeks, we've seen 10 new LNG import projects announced across Germany, Italy, Latvia, Estonia, Greece. We've also seen on the supply side that US LNG import projects have renewed opportunities, of course, as do other LNG exporters such as Qatar. But those aren't going to fix today's problem. Those are going to come in a several year period, 2 to 4 or 5 year period. So to address the 2/3 reduction, Europe's going to have to pull all its levers. And so we've kind of put some numbers around this. There's the possibility to make up maybe 10% of that with increased domestic supply from Norway, the Netherlands, a little bit more piped imports from Algeria, maybe another 5 to 10% from restarting mothballed coal plants, as well as delaying nuclear closures, 15 or 20% by persuading Asian LNG buyers to burn more coal and free up LNG. And of course, you saw Biden promising that we're going to try and get about 10 to 15% of that gap to Europe. Of course, that's highly dependent upon those buyers doing that. And then maybe a bit more from energy conservation. We think about 5 to 15% depending upon the season. That doesn't add up to 100%. And so that's the short-term issue. We see global gas and LNG prices remaining $20 to $30 an MMBTU or higher for the next couple of years. So that's the Europe's focus situation. But while less acute than that natural gas shock in Europe, in the very short term, the crisis is likely going to give energy security and affordability top priority across the major countries. And as we know, to achieve climate goals and an aggressive energy transition, global coordination around sustainability is really required with an overarching policy that allows most countries to row together to get to that 1.5 or 2C world. But unfortunately, the confidence in that broad international cooperation is shaken today. And there are several potential outcomes for the energy transition that we've outlined in the last couple of weeks at WoodMac. And I'll kind of present those two outcomes. And then obviously the reality is it probably is somewhere in between. But the first outcome that we could see for the transition from fossil fuels to renewables is that decarbonization and energy transition measures may be adopted more selectively and from a viewpoint of their contribution to a country's energy security. The developed world may focus more on the access and affordability issue. The developing world would focus more on the access and affordability issue. The developed world would focus more on the security issue. And that could lead to a divergence of energy policies, more pluralistic approaches to decarbonization versus the more universal electrification of the world. And in this outlook, countries are, focusing on diversifying their energy mix in the short and midterm from all sources, while the energy transition is really focused on investing in technologies that reduce carbon intensity of existing value chains. That could be carbon capture sequestration. It could be blue hydrogen, extending the longevity of hydrocarbons. Investment also could increase in small modular nuclear. But the energy transition moves forward, it's just more disjointed, right? And we lose some precious time in that short and midterm under that scenario. The longer term is more uncertain in that view. But the second scenario is a lot more positive. And that looks at the fact that we expect there to be sustained high oil and gas prices, combined with a situation where you would have local policy enforcement and support for energy transition from the major companies in that or countries, and that really gives a boost to the development of low carbon solutions by the private sector, especially. Technology advances, we see the market-driven acceleration of the energy transition. The pendulum shifts back to sustainability in the energy trilemma. Investment balloons in solar and wind, backed up by longer duration batteries. Corporate-driven capital and innovation really enables those low carbon solutions. Those could be hydrogen and ammonia solutions, electrification, carbon capture, but really thinking about the capture side rather than thinking about how to extend the longevity of oil and gas, having enough policy support to move forward. And so in that scenario, despite there being a lack of international cooperation for in the short term, especially, the global policy aligns, and it's really driven by the economics and the technology advancement. And it's driven by the fact that at the national level from the major countries, there is strong policy. And so then there is a renewed coalescing around that global response. And so long-term, there is a significant acceleration in the energy transition. So as I said, it probably ends up somewhere in between, but it's certainly a very dynamic situation. We're early days, but it's also quite exciting to kind of see how this could all play out. And of course, balancing that trilemma that we've always been thinking about and getting it back into a balance. But right now, certainly the focus is purely on energy security.
Thanks, Eric, for starting us off. Very complex situation, yeah. A lot of moving parts, very opaque, and we will know how things work out, by which time we'll already that many years ahead towards climate change, for better or worse. You talk mostly about Europe and the developed world. Let's shift focus a little bit more to the developing world. I have a question for Keiko. And Keiko, given your experience with MIGA and your knowledge of what's going on in the developing countries, again, there's transition renewables, and that transition in some ways is far more challenging in developing countries because the financing of long-term investments like wind and solar is challenging in those countries. So my question for you is, can we expect the private sector to finance the development of renewables in developing countries, as they primarily do in Europe and the US, more developed countries? Or are we still mostly reliant on governments and multilaterals for guarantees and/or direct financing in the developing world?
Well, Bruce, first of all, thank you very much for having me. It's my honor to join this panel. And thank you very much for the very interesting questions. I like to make 2 points. First, the cost of renewable power generation has dropped significantly. Although its investment actually costs a lot of money, having said that, a running cost itself is actually, it's quite reasonable right now. And second, private investors are investing in building renewable energy in developing countries, but they could use support from the public sector. Let me talk about a bit more detail. As for the cost, according to the International Renewable Energy Agency, ILNA, which is the multilateral organizations, almost 2/3 of the wind and solar project in 2021 would generate cheaper electricity than the world's cheapest new coal plants. World Bank Group, led by IFC's efforts called Scaling Solar, helped this move in developing country. The essence of scaling approach is to develop a lowest public-private partnership, PPP model for a single deal and then replicate it. This spreads cost, enhance impact, and encourage programmatic competitive tendering with faster delivery and lower prices, genuinely creating new markets. This is especially true for solar. According to the World Economic Forum report of last year, the cost of large-scale solar projects has plunged 85% in a decade. Solar became the cheaper solutions in some parts of the world, including but not limited to Egypt and Vietnam. I had an opportunity to support the private investor to build the world's largest solar power generation facility in Egypt near Aswan. But private investors often need some support from the MDBs. In Egypt's case, investors have some concern about the potential conversion risk to the hard currency, which actually kind of, getting a little bit of a real these days. But the private investors are investing in renewable energy. I hope I answered to your question, Bruce.
Thank you. Thank you. And to the, along those lines of investors, commercial investors, private investors, increasingly active in the developing world, we're seeing a lot of capital flowing into the renewable energy sector. Let me bring a question to Patrick. And Patrick, I want to ask you about the private investment side.
Sure.
BlackRock is one of the largest, perhaps the largest financing platform for renewable energy. It's a $5 billion fund raised less than 1 year ago. But avoiding catastrophic climate change is going to require a lot more than even $5 billion. In fact, Goldman Sachs, I think, estimates 56 trillion by 2050. So question for you is, what are the hurdles and what are the challenges to investing this amount of capital? Can we put that amount of capital to work? And also, what are the opportunities for investment firms like BlackRock as you look ahead?
Sure. Thanks for the introduction, and pleasure to be on this panel particularly as a CBS alum. But one of the things I'd note is that it's a significant amount of investment required to achieve the climate goals. So I think inherent in that challenge is the understanding that it's going to require a number of different investors, participating in a number of different ways in markets across the globe. So I think with our specific team, which we've been active in the space for the better part of a decade, we only have 10 billion AUM over the life cycle of that, of our franchise, and we are one of the longest standing renewables only focused platforms out there. And so I think, that what I can say with that, and you can see it through the legacy of our funds, is that, there's been a significant acceleration in, investor interest and appetite in putting capital to work in this particular space. Our original fund was sub 1 billion, and as you note, our most recent raise was $4.8 billion just last March. And in fact, we ultimately raised a second fund last year that closed in October. That is much smaller because it's the first of its series, but a fund that's going to execute that same climate finance private equity investment strategy, focused exclusively on the emerging markets, with the understanding that those markets are going to have to be participants in the energy transition as well. Obviously, as Eric noted, there's a number of reasons that different countries will have to take different approaches and will be on different timelines with respect to that transition. But participants nonetheless. And so I think, some of the challenges are that there are hundreds of different countries. You take a continent like Africa, even specifically, people talk about it as if it's a monolithic single entity, but it's over 54 sovereign nations, all with different goals, different legacies, different energy resources, et cetera. And so folks are making very different decisions, not doing it necessarily in a coordinated fashion with respect to, their own energy needs, whether it is a focus on energy security, focus on, renewable energy and energy transition, focus on energy access, et cetera. So the challenge is trying to take all of these different actors and getting them to act in a somewhat uniform and coordinated fashion, yeah, to create an environment that is supportive for renewables. From an investor's perspective, we need a couple of different things. We need, and we we are an investment manager. We need LPs, limited partners, investors, so your pension funds, your insurance companies, et cetera, to be interested and focused on deploying capital to the region. That's who we raise capital from. Then we need environments that are fertile and supportive to the investment in renewable energy, which often requires government support in that regard, lowering the hurdles and the barriers to investment. So in the context of the United States, it's having clear policy in support of renewable energy. Historically, the development of renewable energy in the United States has been driven by tax incentives, PTCs in the case of wind, ITCs in the case of solar. And those policies, when the government is supportive of the industry, provide some window of visibility that provides access to the